Hello, gentlemen, and welcome to another Palaview Market Research video. Today, I'm going to be giving you my macroeconomic outlook, and it's all the data I'm kind of looking at right now in May 2024. So, I want to highlight to you guys how important this is. The inverted yield curve just hit today, as of today, 727 days inverted. Previous record, like we discussed in previous videos, was 624. So it's very easy for us to forget that we are in this very strange historical moment. And if you don't already know, an inverted yield curve has predicted the past 7 recessions. You can see that the moment that the inversion is corrected, floating above this red line, a recession is triggered, and that's what these gray little bars represent. So what is it? What does it mean? What does it mean for your equity positions in a moment where that correction is made when a recession is triggered? Well, in the 2000 recession, there was a inversion that led to the S&P falling about 49%, right, from its peak in early 2006, 2007. A decline of about 57%, and in the 1980s, a S&P 500 drop of around 20%. So we're looking at anything between, I would argue, 15% and 60% in a recession triggered by an inverted yield curve, which is probably inevitably happening. Okay, but these are interesting times. Another thing that's happening that can exacerbate the recession that gets triggered from this is interest rates, and the nature of where interest rates are trending and where people thought interest rates would be at this time of the year, at the beginning of this year, is very different. So first of all, I want to highlight how unusual this time was, okay? And this basically was some of the best economic growth in the history of our country happened during this period. But as you can see, this is the entire history of the federal funds rate, okay? And it's the lowest it was ever it has ever been, right? So to expect that they'll actually bring rates to this low ever again is a massive assumption. We should assume that we should be sitting around the historical rate, which is 5.42%, which is what we are at right now, effectively at 5.5. So a really important thing to keep in mind here is that if rates do not go down below 4%, a lot of corporate debt and real estate will not be able to refinance. And that will lead to massive defaults in the next recession for both companies and real estate portfolios. So, what does that mean? It means that the nature of your portfolio should be changing because when rates are high, investor demand for debt investments goes up, and it's maybe a lot of the times outweighs the demand for equity investments. And when rates are low, investor demand for equity investments are high, and and that's what it's been like. That's why over the last 15 years, the venture capital guys have been the smartest guys in the room. And the guys in the 70s and 80s who were dealing with higher interest rates that we're showing here, right? In the 80s where you see that how high these rates are, the guys who were making money weren't the venture capital guys at that time. The guys who were making money are the creditors and the lenders, all right? So, what do high interest rates generally mean? They mean less construction. And that means that there's less new housing supply. And less new housing supply leads to rising real estate prices, right? That's pretty simple. That's pretty intuitive, right? And then also, less new housing supply means less jobs, okay? Again, high interest rates cause higher mortgage rates, right? Very intuitive. So, high mortgage rates leads to increased demand for rent because people can't afford the homes they thought they would. There are a lot of Americans who are waiting for rates to go down. They're waiting for housing prices to go down. But if new supply isn't coming online and rates don't go down, then housing prices are going to stay the same, if not continue to go up. And it's just not going to get cheaper to do so. So the demand for rent's going to go up. So you're going to see rents surge in the next I would say 2 to 3 years. I think whatever you're renting right now for 2,000, 2,200 a month is going to go up to 33, 3,500 a month. Doesn't really actually matter what market you're in unless you're in like a shrinking economy like St. Louis or something. Okay. So if demand for rent goes up and new supply goes down, rent prices spike. Okay. This bottom chart is really, really effective at showing what we're like, visualizing what we're talking about here. It would be nice if we were able to also show, housing prices in this, but this is actually showing In this blue line, monthly supply of new houses, right? And you can see that there was a surge here. But keep in mind, this is a lagging indicator because all of this construction that brought this online happened, 3 to 5 years back, right? When interest rates were low, where they can secure those construction loans, right? So this spike is going to continue to fall. And if we see this fall, right, the monthly supply of new houses fall, while housing inventory estimates continue to fall, then we're going to see this plateau, or this red line, which it already has been for a long time, effectively, right? So that means that housing prices are going to stay the same and rents are going to surge. Okay. So that's kind of just a high level macro on what I'm seeing right now. And I'm focused so much on, federal funds, interest rates, and real estate because that is the foundation of our economy, guys. Like real estate is the precursor to banking, and everyone, you know. But we'll talk about that more in depth later. But that's today's video, and I hope you enjoyed it. And we will continue doing these. Okay? I love making these videos for you guys.